The old, the new, and the FDIC. Hi, everyone, and welcome to another episode of Insights, brought to you by Ainslie Bullion and the Gold and Silver Standard. Today, we welcome for his debut on Insights, Sam, who has been looking at a whole lot of different things that he put into the news piece today. So I'm very excited to have Sam here to have a chat about where we've been, where we're going, and really his take on a whole range of the impacts that are impacting the economy right now. So welcome, Sam. How are you?
Great. Thanks for having me on, Chris.
Loved your piece today. So let's start off at the beginning, because that's sort of how you started the article. How are the markets today different to how they were in the past? Because I thought that was a really interesting place to start the discussion.
Yeah, well, that's something my clients have always asked me. And look, a lot of things are different, but some things never change. So the things that are different are essentially you can carry your charts around in your pocket. You can trade at any time. There are more derivatives now than there have ever been. And it's very easy to get access to market news, place trades, and do pretty much whatever you want in the markets just at the touch of a fingertip. What hasn't changed is people are notoriously bad at evaluating what's going to go up, what's going to go down, when, and what actually has value. So if you're curious, you can research a mine manager who started off in Western Australia. And he was a young American man named Herbert Hoover. So he started in the late 1800s. Obviously, he went on to become US president. But one of his biggest successes was going around China when the railroads were being built and selling shares in gold mines. Now, that was great. Who wouldn't want gold mine rights? And the value, you can show on a chart, it's going up and up and up. So he made a huge amount of sales and got very wealthy doing this. The only problem is when the shares went to zero and everyone asked why, and they went to go inspect the mines, they found out that all the gold was gone. It had already been mined. So that's where the term comes, being given the shaft.
Okay.
All the gold's gone, and that's what you get. People today might think that term means something else, but it's actually to do with trying to make an investment and not actually looking too much into it. So that's the same thing that's happening today. You have people buying all sorts of things, whether it's just a picture of a monkey or something like that. As long as they see value going up or down, they try to make a decision solely based on a chart, and that can be very devastating.
So that probably leads to an interesting point about this idea of physical versus derivatives. We have this discussion, obviously, at Ainslie all the time with customers who sort of are trying to make that decision about why do they buy physical gold, as an example. Why does it matter to you, this idea of having something physical versus those derivatives that you've spoken about?
Well, look, derivatives are great for speed of trading and things like that. But when people come to collect, if it's not there, there's an obvious problem. Like with the mining example I gave,
Yes.
if you go to try and see how much gold is there and there isn't any, well, then your investment's worth zero. So, I mean, you can look at the paper to gold ratio and you can see currently it's about 1 to 124. So if someone's going and buying gold, typically the reason for that is as a hedge against crisis. Now, if crisis comes and you go to try to get your asset and it's not there, they're giving out more pieces of paper than the gold they have in the safe, you're in trouble. So if you actually have the gold in your hand, you're 100% sure that you have your gold.
Yeah.
So
And that's a really interesting point that I think about a lot is people, particularly with something like gold, when they're buying it for times of crisis, they really need to understand that during the times of crisis is the time when you're most likely to experience the third party risk. So when everything's going well, it'll be easy to get your underlying, but when everything's not going well is the time. And it might not be that even that they don't have it. It might just be that everyone wants it all at once. So you've got to have the physical infrastructure in place to deliver all of that. It can become quite messy.
yes, and even when if you look at the inverted pyramid with assets at the bottom and then it goes up to derivatives, in a time of crisis, that inverted pyramid starts to collapse, and it becomes very difficult to, go from something so big into something so small. So the competition just increases dramatically. Even for something like Australian dollars, for example, if a stock market's crashing, one of the first things you see is the currency spike, because everyone's going to the stock market to pull out their money. And what are they getting? Well, they're not getting shark's teeth or something like that. They're getting Australian dollars. So you see a spike, and then afterwards you see another correction. And typically something like gold tends to go up after that. So it seems like
it does make sense in that sort of example that you're giving, that you've got a lot of people. It's like all trying to squeeze through that small door at the same time. It pushes the price up. That's your supply and demand dynamic. I'll change the topic slightly. Just, you mentioned AI in the news today, and I thought that was an interesting sort of little side note that you're making. Do you think that, like, my personal view is that we are in the early stages of AI being able to solve a lot of these problems, but I probably agree with what I think your sentiment was in the article today, that we're not ready for that yet, and that these problems won't be solved yet by AI. Can you give us a little bit of an overview of your thoughts on where our AI fits into this picture?
Yes. So look, AI is a fantastic technology. It can do pretty much anything. It looks like it's potentially going to put a lot of musicians and artists out of the job, because everyone will be able to do it by just typing a keyword. But with AI, I mean, if you look at the liquidity expanding and contracting in markets, unless AI can do something like take a time machine back and change interest rate policies, it's kind of hard to see how it's going to stop the rippling of pretty much free money, and then whiplashing over to raising interest rates, and seeing that ripple through the economy and actually hit people who are spending money on credit cards to pay for their bills and things like that. Mm-hmm. I mean, unless the technology advances so much, it's going to help clear credit card debt and fix all these problems we have. It's really hard to see AI putting a dent in the problems that are already there and are still unfolding.
Yep. And that I probably agree with that. I'm very optimistic long term, but the short term, the problems that you've mentioned there just don't seem solvable by the sort of models that we're working with in the here and now.
Yeah, look, if the FOMC hands everything over to ChatGPT and says, how do we create a steady economy, not a big boom and bust economy, maybe we could improve. But until then, it would be hard to imagine.
And it's very hard to imagine that, even though I suspect ChatGPT would do a much better job at giving you the correct answer there, the power and politics involved, I can see that being a very long way off before anyone would be prepared to do that.
Yes, exactly.
And I suppose on that theme of power and politics, you then turn to the banks, which is something we've been talking about a lot on Insights. We've had those discussions with Alex and Branko about these banks that are collapsing and why they're collapsing. I'm curious to get your take, actually, on where you think we are in this crisis currently and how you see it playing out. Because, again, talking about power and control, you mentioned central bank digital currencies, CBDCs, in the news today. I know that's highly controversial. You've got some people who are arguing this could be a great technology that could really help to solve a lot of problems, and other people who probably rightly are very fearful of government overreach. It might not start that way, but it could certainly turn into that when you've got programmable money. So if you could maybe answer that, or give us your perspective on that. First of all, where you see us in the banking crisis, and secondly, how you think the potential of CBDCs play into that.
Yes, well, these two topics could potentially be best friends, because the best way to implement a change is, during a crisis. Now, what's happened with the FDIC is, I mean, this corporation is supposed to exist to protect depositors, but what we've had is them essentially broker a huge sweetheart deal for JP Morgan, which is the biggest bank in the US. They're probably the last one that needs help. So instead of going and helping out depositors, they're helping out the largest, most powerful bank in the US, arguably, by getting First Republic's assets and securities, etc., which all add up to about 295 billion. And I was just reading an article by Politico, and it looks like everyone's using the same term, assume. So they're assuming 295 billion, which
So that sort of sounds like a gift, maybe, is it?
well, it's a way of not using the word gift. I would call it a gift. You would call it a gift. They're calling it assuming. So it's a very nice assumption, getting 295 billion.
I'd like to assume I had 295 billion extra in my account too. That'd be lovely.
Yes. So that's what they're calling it. But essentially, it's a concentration of power. Now, we know in business, the large grocery store buys out the small grocery stores and consolidates. But here we have essentially a weaponization of the FDIC to help facilitate that process, which is very controversial. Now, the G7 are currently planning a meeting because they're looking at ways to prevent runs on banks. Now, runs on banks, how can you prevent that? I mean, if you take 5% of the cash out of a bank, banking system in a country will collapse because there's just not that much cash. So one of the solutions is a CBDC or CBDCs across all developed countries. And that way you can never take money out of the account because it's locked in the account. Completely programmable digital currency, which is the opposite of Bitcoin in almost every way, except for that it's digital. So, so yes, with more banks collapsing, who does it benefit? What could it lead to? Well, the more banks that collapse, the more they get consolidated, potentially by these bigger banks, which is a big win for them, and the more reason to go with a CBDC. So those are two major potential outcomes.
And they're both very important to understand. I actually don't feel that they're seeing the bigger picture, the US here, because I know in Australia, for example, we only have the big four banks, and we have really a handful of what we would consider regional banks that operate around those.
The job is done here.
That's right. That's right. And it's not a feature. It's a bug of our system. I think the fact they have so many regional banks is actually a huge benefit in the United States, because it means you've got lenders that can specialize. There's a lot of benefits there, and it seems like such a shame that they're just letting it collapse in that way, when there could have been other solutions than to not gift to what the word you use, appropriate it all effectively. Assume, that's right. Assume it all over to JP Morgan. Like, it, to me, it's just, I think we'll look back at that in hindsight and go, the US will go, what were we thinking?
Yes, exactly. And look, we have the CPI data as well coming out at 10:30 p.m. Melbourne, Sydney time tomorrow night. So that could potentially add fuel to the fire.
Yeah, absolutely. Because I think up until probably recently, it looked like that was all pulling back. Now we're not quite so sure. So what's your take on that? Do you have any sort of feel for where it might be going? And I'm also interested to know what you think that might do to the price of gold.
Well, look, inflation's expected to be, a bit worse than before. The ECB has been talking about inflation is too high as well. We all know when central banks complain about inflation, they're looking for an excuse to either hold interest rates high or hike them even further, or at least push the market in the direction they want. Because what people don't realize as well is if people are all buying, that creates inflation. So even them scaring people out of the market has a similar effect to raising interest rates. So look, the effects from this, I always like to look at the worst case scenario. Mm-hmm. And probably the worst case scenario is that we get big moves going both ways. For example, there's an artificial positivity, which makes markets rocket higher, or there's hope of some sort of stimulus that doesn't come through, and then there's a big drop downward that liquidates a lot of traders. And then eventually, when a potential pivot does come, it rockets up so quickly, the investors who got knocked out have to jump back in at a much, much worse price than where they were either knocked out of or manually closed out of because of fear.
Yep.
So again, it looks like the worst case scenario is a move both ways to essentially cause maximum pain.
And that's been consistent with what a number of people have said to me. This idea of volatility is definitely here to stay for the medium term at least.
Yeah, well, look, I've had investors for years asking me in regard to hedges. They say, a lot of the speakers I've watched, they're all doom and gloom. They say a big crash is coming, but it's never come. And you wouldn't believe the number of investors who I've advised in 2020 and in 2021 asking, when is there ever going to be a crash? They've been talking about it for 10 years. And I said, do you realize 2020, we've had a sharper sell-off than the Great Depression. So you can show people things, but it's up to them to actually look at it. And
what more do you want? It happened.
Yes, it happened. It's unprecedented. So, and then we have what's going on now. What's going to happen this year? What's going to happen next year? Nobody knows. But if you look at record Google searches for how to buy gold are happening now. Yep. So it looks like the general population is starting to catch on and starting to have enough fear to actually look into alternatives to a potentially overheated stock market, and all sorts of other investments out there where they're just saying, look, I don't understand, but things aren't looking good. How do I buy gold?
Fascinating. Well, Sam, it's been so great to have you on. Hopefully we'll be able to get you back again. You've got such a wide-ranging knowledge on all of these things that are happening at the moment, and it's very interesting. So thank you for your time today.
Thanks, Chris.
Thanks everyone for watching. Remember, reach out with those questions or comments on the social platforms. We'll get back to you. That's us for today. We'll be back again tomorrow with Branko, I think. So that'll be good to get his take on where we are in this situation as well. But really appreciate Sam today. We'll keep an eye on those topics that he's raised, and we'll be back to talk more about all things gold, markets, metals, all of that next time. So I'll talk to you then. Bye.